In the world of finance, few assets are as familiar and as universally captivating as gold. It hardly needs an introduction. Gold has always held a unique place in human perception, so valuable that we often compare life's most precious things to it. Time is gold, worth its weight in gold. These phrases reflect not only its material value, but also the symbolic power this metal carries across cultures. Beyond its widespread use in jewelry, gifts, and traditional wedding customs in many Asian countries such as China, India, and Vietnam, gold is also considered one of the most reliable defensive investment assets. During its historical peak, gold formed the backbone of the global monetary system, serving as the primary medium of exchange and playing a key role in macroeconomic stability. Therefore, to understand why gold remains a safe haven today and why it is often viewed as a barometer of economic health, we must look closely at its origins and its inherent characteristics. Let's begin with its physical and chemical properties. Gold is the most malleable metal in nature, capable of being bent, stretched, or shaped into countless forms without breaking. It is exceptionally durable, resistant to oxidation, and immune to corrosion, even against many strong acids. This stability means gold does not degrade over time. Furthermore, gold has a very high density, far greater than most metals. This makes detecting fake or diluted gold relatively easy, because even small impurities significantly alter its weight. Its melting point, 1064 degrees Celsius, shows just how resilient this metal is under normal conditions. From a philosophical perspective, the combination of durability, rarity, and broad utility gives gold a sense of permanence. It plays important roles not only in jewelry, but also in technology, medicine, and the arts, while simultaneously being recognized by nearly every economy as an asset with intrinsic value. But the most decisive factor is this: gold is inherently scarce. According to scientific estimates, Earth may contain roughly 6 times 10 to the power of 13 tons of gold, over 60 trillion tons. Yet much of it lies deep beneath the oceans or in geological layers beyond our reach. Throughout all of human history, we have extracted only about 200,000 tons, which is less than 0.0000003% of the theoretical total. The deeper we go, the higher the extraction cost becomes, sometimes dozens or even hundreds of times more expensive, making most of Earth's gold practically inaccessible. This combination of chemical perfection, near-eternal durability, extremely limited supply, and universal acceptance has turned gold into a kind of global language of value. And it is for this very reason that whenever economic instability rises, capital flows naturally back to gold as a safe harbor. From a philosophical perspective, the rarer something is, and the more labor it requires to obtain, the more valuable it becomes. Gold fits this principle perfectly. But wait. If human beings were able to create synthetic diamonds as early as 1953, why hasn't anyone successfully produced synthetic gold? The answer is, they actually have, at least in theory. Scientists have long understood how to create artificial gold using nuclear reactions. By adding or removing protons from the atoms of common metals, it is theoretically possible to transform them into gold. To explain it simply, a gold atom contains 79 protons, while mercury contains 80. Some ambitious researchers explored the idea of removing one proton from mercury through nuclear transmutation, essentially turning it into gold. But here's the problem. The cost of operating a nuclear reactor for such a process is astronomically high, often exceeding the value of an entire gold mine. In fact, producing even a few micrograms of artificial gold can cost more than extracting several kilograms of natural gold. As a result, synthetic gold is economically meaningless, and gold remains a naturally scarce metal whose value continues to endure through time. Historically, gold has played an even more important role in the global economy. It has been used as a form of currency since ancient times. During the Qin dynasty in China, for example, gold was cast into coins for trade and commercial exchange. This alone shows that early civilizations recognized gold's intrinsic value and trusted it as a medium for representing labor, wealth, and stability. This trust eventually shaped the financial world. In the 19th century, the gold standard was established, creating a unified foundation for the global economy. Under this system, a currency's value was directly tied to the amount of gold it could be exchanged for. In simple terms, governments could only print as much money as the gold reserves they held. This created discipline, transparency, and long-term confidence in national currencies. However, everything changed during World War I. Nations needed enormous amounts of cash to fund military operations, purchase weapons, and cover medical and logistical costs. The demand for money exploded far beyond what gold reserves could support. Shortly after, the world was struck by the Great Depression in the late 1920s. As mass production outpaced consumer demand, economies collapsed and unemployment soared. To revive economic activity, governments had no choice but to inject massive amounts of money into circulation, something the gold standard could not accommodate. Ultimately, the strict gold-backed monetary system began to crack under global pressure, and countries were forced to abandon it in order to survive. As the world moved into the 20th century, it became increasingly clear that the classical gold standard could no longer support the growing complexity of global finance. After World War I, the economic landscape had changed dramatically. International trade expanded, capital flows intensified, and governments required more flexibility to manage economic shocks. All of these forces set the stage for a new monetary framework, the Bretton Woods system. In 1944, representatives from 44 nations met in Bretton Woods, New Hampshire, to redesign the international financial order. Instead of returning to a pure gold standard, they created a hybrid model. Under this new system, the US dollar, not gold, became the central anchor of the world economy. The dollar was officially pegged to gold at 35 US dollars per ounce, and all other currencies were pegged to the dollar. In effect, gold still maintained influence, but indirectly, through the United States. The logic was simple. After World War II, the US possessed the world's largest gold reserves and the strongest industrial base. Pegging the global financial system to the dollar seemed like a stable solution. For a time, it worked exceptionally well. Bretton Woods supported global reconstruction, stimulated trade, and created unprecedented economic growth during the post-war boom. However, beneath the surface, the system carried a fundamental contradiction. For the world to grow, more dollars needed to circulate internationally. But the more dollars were printed, the harder it became for the US to maintain the promise that each dollar could be converted into gold. By the 1960s, US spending on the Vietnam War and large-scale social programs flooded the world with dollars. Foreign governments began doubting whether the US truly held enough gold to back its currency. Countries like France demanded gold redemption in massive quantities, draining American reserves. The pressure finally broke in 1971. In what is now known as the Nixon shock, President Richard Nixon unilaterally closed the gold window, ending the convertibility of dollars into gold. Overnight, the Bretton Woods system collapsed. The world shifted into a completely new era, fiat currency, where money derives value not from gold or any physical commodity, but from government authority, economic strength, and collective trust. This transition changed everything. Exchange rates became flexible, central banks gained much more power to adjust monetary policy, and global finance entered a period of volatility and innovation. But this shift also had an unintended consequence. Without gold backing the system, investors began seeking gold as a hedge against inflation, currency devaluation, and financial instability. Gold, ironically, became even more important in the post-gold standard world than during the gold standard itself. Today, although no major economy uses gold to back its currency, the metal remains a critical financial asset. Central banks around the world continue to accumulate gold as a strategic reserve. When inflation rises, geopolitical tensions escalate, or financial markets destabilize, global demand for gold surges. Its role has transformed from a formal monetary base to an informal measure of trust in the economic system. In other words, even after the gold standard ended, gold did not lose relevance. Instead, it assumed a new identity, a universal hedge, a psychological safe haven, and a silent benchmark for global economic confidence. Gold as the brake pedal of global investors. Over the past decade of studying the gold market, I often describe gold as the brake pedal of investors. People don't step on the brakes when they want to accelerate. Brakes are used when danger appears. Gold works exactly the same way. It is not a driver of economic growth, but it becomes an essential safety tool when warning signs emerge. When inflation rises, currencies lose value, real estate becomes illiquid, or financial markets fall into turbulence, gold often maintains its purchasing power, and in many cases, its price even increases. This helps investors preserve the real value of their wealth, keeping both the quantity and quality of their assets relatively intact during periods of economic instability. Compared to stocks, bonds, real estate, or bank deposits, gold remains one of the safest havens available. Stock markets can crash overnight, especially when major investors trigger panic through sudden sell-offs. Real estate, despite being a tangible asset, is highly vulnerable to speculation, credit cycles, and manipulation by interest groups. Bank deposits feel secure, but their real value is eroded whenever inflation rises above interest rates, resulting in invisible losses for savers. This is why professional investors consistently recommend allocating a portion of gold within a diversified portfolio. Gold reduces overall risk and stabilizes long-term returns. Why rising gold prices often signal economic distress. However, it is important to understand that rising gold prices are rarely a sign of economic prosperity. In many cases, they reflect weakening trust in the future. When households and institutions accumulate gold over long periods, capital flows are diverted away from business investments, reducing liquidity in the real economy and slowing overall growth. We often hear stories of people becoming wealthy from stocks, technology, or venture capital. But almost no one becomes rich overnight from holding gold. Gold protects wealth. It does not create new wealth for society. This is why economists often consider persistent gold price increases as a warning sign rather than a celebration. Gold prices closely correlate with geopolitical risk. Recent history provides clear examples. In May 2024, Russian President Vladimir Putin met with China's President Xi Jinping, and both sides affirmed cooperation to counter what they described as hostile pressure from the United States. Just 1 week later, gold surged to $2,459 per ounce, more than 25% above its previous local peak. From the Israel-Hamas conflict to Western sanctions against Russia after the Ukraine war, geopolitical fractures have repeatedly triggered gold rallies. The removal of major Russian banks from the SWIFT international payment system further accelerated this trend. Facing restricted access to global finance, the Russian government significantly increased gold purchases. In the first 3 months of 2022 alone, the Central Bank of Russia bought 100 tons of gold, lifting national reserves to 2,300 tons, worth roughly $140 billion. In short, whenever global uncertainty rises, gold becomes the ultimate lifeline, and rising gold prices reflect growing fear in the economic system. Gold price outlook 2025 to 2030. Professional forecast. To understand gold's future, especially between 2025 and 2030, we must analyze the metal through 3 major forces shaping the global economy: the interest rate cycle, geopolitical realignment, confidence in fiat currency. 1. Interest rate cycle. From 2025 to 2027, many economists expect the U.S. Federal Reserve to gradually lower interest rates as the economy slows and inflation stabilizes. Historically, every major rate-cutting cycle, 2001, 2008, 2020, has led to strong gold rallies. Lower yields reduce the opportunity cost of holding gold, making it far more attractive. 2. Geopolitical fragmentation. The world is entering a period of increasing geopolitical fragmentation. US-China rivalry, conflicts in the Middle East, the expansion of BRICS, and the global trend toward de-dollarization. As trust in US dollar dominance weakens, many central banks have accelerated gold accumulation. Central bank gold purchases in 2023 to 2024 reached the highest levels since modern records began. This demand is structural and long-term, creating strong underlying support for gold prices. 3. Confidence in fiat currency. Global debt surpassed $300 trillion in 2024, an unprecedented figure. Rising debt levels raise concerns about the long-term credibility of fiat currencies. In situations of debt crisis or monetary instability, gold becomes the ultimate hedge because it cannot be printed or inflated away. This macroeconomic backdrop provides a powerful tailwind for gold through the next decade.